Dave Ramsey, when it comes to mortgage, you are wrong. In today's video, I'm going to debunk Dave Ramsey's views on mortgages, disagree with his view on the 30-year fixed mortgage, why you don't need a 20% down payments, and why conventional private mortgage insurance isn't the end of the world. In the comments below, please share what you think. Are you an advocate for the 30-year or the 15-year? Do you think putting 20% down is important? Or would you consider putting less than 20% down? Also, stay tuned as I share my personal story of how my modest 3.5% down payments transformed into hundreds of thousands of dollars in home equity. You don't want to miss this story. Before diving in, though, I want to acknowledge Dave Ramsey's essential role in guiding Americans towards financial discipline. His advice has been crucial in steering individuals away from debt and towards financial peace in a consumer-driven society. America needs Dave. However, while I respect Dave and his mission, my view on mortgages is based on affordability, flexibility, and practicality, something most Americans also need in our current times. Point number one, the 15-year fixed versus the 30-year fixed. Dave Ramsey strongly advocates for the 15-year fixed-rate mortgage. It does sound appealing, clearing your entire mortgage in 15 years and achieving mortgage-free status. However, this seemingly ideal plan comes with not just one, but several significant drawbacks. The first drawback is affordability. Home values across most U.S. markets are currently at or near historic highs, and interest rates are at levels not seen in decades. Let's dive into the data, comparing interest rates, monthly payments, and interest costs over the life of both a 15-year and a 30-year fixed mortgage. For instance, consider a $400,000 loan on a 30-year fixed rate at 6.875%. The monthly principal and interest payment would be $2,627.72. Now, one advantage often associated with a 15-year fixed is lower interest rates. According to an online search, the average rate stands at around 6.25%. For the same loan amount of $400,000 amortized over 15 years at a rate of 6.25%, the monthly principal and interest payment would be $3,429.69. Dave Ramsey's strong advocacy for the 15-year fix over the 30-year fix primarily centers around interest costs. In this scenario, the 15-year fixed would accumulate a total interest cost of $217,344 over the 15 years, significantly less than the $545,977 in interest costs incurred on the 30-year fixed. This means the 15-year fix would potentially save a substantial $328,632 in interest payments. This interest savings has always been Dave's focus, but there's more than meets the eye. In fact, Warren Buffett shared his perspective in an interview with CNBC in 2017, stating, "The 30-year mortgage is the best instrument in the world." He highlighted definite advantages to opting for a 30-year loan. It's intriguing that the world's most renowned investor holds this view in stark contrast with Dave Ramsey's steadfast preference for the 15-year fixed. There are a few reasons behind this disparity. One key factor is that Warren considers the concept of opportunity costs, whereas Dave predominantly focuses on interest costs alone. The often overlooked aspect, according to Warren's perspective, is the role of inflation, particularly in relation to the 30-year fixed monthly payments, compared against future increases in wages, serves as a crucial factor that isn't commonly discussed. While it's true that the 30-year fix may cost more in terms of dollars, future wage increases act as a significant subsidy. The monthly mortgage payment will remain constant for 30 years, while income will increase with time. As an example, assuming household income of $85,000 at the time of closing in 2023, with a historical wage increase of 3% annually, that income could potentially increase to $128,000 after 15 years and an estimated $200,000 after 30 years. Therefore, although the interest cost in dollars is higher, when corrected for inflation, this increased cost can be substantially subsidized or even entirely offset by future increases in income. Secondly, the 30-year fixed rate offers significantly more flexibility in cash flow. with a monthly payment of $26.27 compared to the $34.29 required by the 15-year fix. The 30-year option presents a monthly savings of $801 every month. This substantial difference empowers individuals with greater control over their cash flow. The $800+ monthly savings can be invested, directed towards an emergency fund, allocated to a college fund, or even utilized to accelerate principal paydown on the same 30-year fixed rate note, among just a few options. This aspect of flexibility is often overlooked. With a 15-year payment plan, the higher payment is mandatory. In contrast, with the 30-year payment plan, one is only obligated to make the standard 30-year payment, but gains the option to make additional principal payments monthly, annually, lump sum, or on a discretionary basis with no restrictions. This level of control over cash flow on a 30-year payment plan is important. While the note rate may be higher, making even a single additional principal payment can wield significant power. For instance, the chart in the graphic shows making one extra principal payment of $26.27 after the first month can shorten the loan term by 8 months, saving over $18,000 in loan interest. This not only reduces the total interest paid, but also impacts the effective rate. In essence, a 30-year payment provides control over cash flow, coupled with the option to pay the loan off early while still adhering to the minimum 30-year payment. That, by definition, is flexibility. And flexibility isn't a good thing, it's a great thing. Lastly, a 30-year fixed rate payment offers a higher level of security. In the face of financial hardships, unexpected life events, or a loss of income, having a lower 30-year fixed payment can be a crucial safety net. While maintaining an emergency fund is advisable, the choice between a 15-year fixed payment that is $801 higher per month and the more manageable 30-year fixed payment becomes pivotal during challenging times. And that analysis, friends, is something you won't find on the Dave Ramsey mortgage calculator. Point number 2 is the Dave Ramsey 20% down argument. Dave Ramsey strongly advocates for always putting at least 20% down payment. And I respect that perspective. For those who have the means and consider a substantial down payment essential, it can be a prudent choice. However, I firmly believe that the inability to put 20% down alone shouldn't disqualify someone from homeownership. In 2023, the average age of a first-time home buyer in the United States was 34 years old. And many millennials simply don't have the financial resources to make such a substantial down payment. Should we advise them to abandon their dreams of homeownership? I don't think so. Consider my personal story. In 2010, I purchased my first home with a minimal down payment of only 3.5%, roughly totaling $4,500, as that was all that I could afford at that time. Despite not having the means to put 20% down, it didn't hinder my journey to homeownership. With no other debts and a mortgage payment comfortably fitting within my budget, and yes, on a 30-year term, I took the plunge and bought my first house. Fast forward 5 years later, I opted to sell the property and relocate. The outcome? I realized over $70,000 in capital gains. I reinvested the entire sum into my next property in 2015, which has in turn appreciated significantly over the past 8 years. What began as a $4,500 investment in 2010 has transformed into hundreds of thousands of dollars in home equity just 14 years later, an illustration of one of the remarkable potentials of homeownership. Consider the alternative scenario. If someone waited an additional 5 years to save up for a 20% down payments, how much would have home values surged during that time? What about interest rates? How might that impact their monthly payments and future prospects? These are questions that should be asked and probably answered for those that are insisting on 20% down. Hey friends, if you are getting any value from this video, please hit that like button. And if financial literacy is something you want to learn more about, or if you want to share what you have learned and what you are doing, I'd like to extend you an invitation to join our community by subscribing. Remember, financial literacy isn't taught and it isn't valued in our education system at all. So it's up to us to learn, to grow, to share, and to build together. So please subscribe, join this community, and share this video. I want to hear from you. Your voice matters. Now let's get back to the video. Point number 3, conventional private mortgage insurance is not the end of the world. PMI serves as insurance for the lender when the borrower puts down less than 20% down on a conventional loan. And it's crucial to distinguish it from FHA mortgage insurance premiums. Unlike FHA premiums, PMI follows a risk-based pricing model. This means the rate and fee are determined by individual qualifying factors like credit score, property type, occupancy, debt-to-income ratio, and other relevant considerations. The better someone's qualifications, the more favorable pricing they can secure. Unlike FHA loans, conventional PMI offers borrowers flexibility with at least 5 different payment options. And this is something I have never heard Dave talk about. The better qualified the borrower, the more affordable the rates. Sellers can even pay the entire PMI premium through a credit at closing. Yes! Sellers can pay for all of the buyer's PMI at closing through a seller credit, but Dave never mentions this. If paid monthly, PMI automatically drops off at 78% loan-to-value ratio. And homeowners can request its removal as soon as the equity hits 20% or higher. Monthly PMI rates are often cheaper than FHA, and various payment options are available, with the eventual elimination of payments. Also, many banks can shop for PMI. It's private mortgage insurance, obtaining multiple quotes to secure the best possible deal for their customers. If you're considering a purchase and need PMI, empower yourself by asking your lender about available options, whether the seller can cover it, and if they can shop for PMI with different providers. The more questions you can ask, the more informed and empowered you become in the process. In the end, Dave has his opinion, I have mine, and I certainly have my opinion about Dave's stance. However, the most important opinion is yours. If you're contemplating a purchase or considering a refinance, ask questions, stay informed, weigh the pros and the cons, and make a decision that aligns with your family's best interests. And I encourage you to make an informed financial decision based on your unique circumstances. You might hurt Dave's feelings, but you certainly won't hurt mine. And whatever you decide, well, you have my support. This is Ben Adams with American Money 101. Until next time.